Hello dear traders, the US stock market closed with a rise for the seventh week in a row. The new trading week started on a positive note, which is considered a consolidation at the reached levels. It is highly possible that the previous week was the last active period this year. This week, investors are likely to search for confirmations of the key rate cut expectations in 2024. Notably, some actions by US monetary authorities have already caused some doubt among traders, thus making them nervous. New York Fed Reserve President John Williams said that rate cuts were not a topic of discussion for the central bank. The politicians are focused on the question of whether they have gotten monetary policy to a sufficiently restrictive stance to ensure that inflation comes back down to 2%. Against this backdrop, all eyes are turned to December's Business Leaders Survey and this week's Housing Market Index results, which may give additional hints. Stay tuned, the financial market is always rich in unexpected and interesting events. Watch the video till the end and share your opinion in the comments. Since there are no other market drivers, traders will wait for the most important information this week, including data on the personal consumption expenditures price index, which is closely monitored by the Federal Reserve. In terms of corporate data, the week started quite actively. Thus, shares of United States Steel Corporation jumped by 25% after Japanese company Nippon Steel agreed to buy US steel. Shares of Amazon, Nvidia and Meta increased by more than 1%, while Apple's shares dropped by about 1%, amid the news that more and more Chinese agencies and companies receiving government support have banned their employees from using iPhones and other foreign devices for work purposes. The issue of the key rate cut is still the most discussable. No one doubts that the Fed has ended its hiking cycle. The only question is when the regulator will start the monetary policy loosening. There were some reasons for the rally we saw last week. The Dow Jones increased by 2.92%, the S&P rose by 2.49%, and the Nasdaq composite advanced by 2.85%. 10 out of 11 S&P sectors ended last week in the green, with leading positions in real estate, commodities, and industry. The jump took place after the Federal Reserve maintained the benchmark rate at the current levels and announced 3 cuts in 2024 amid a slackening inflation. All 3 indices, including the Dow Jones, received an impulse to continue the uptrend despite tough conditions in the currency market. The Dow Jones reached a new all-time high, breaking the level of 37,200. Changes in the FOMC forecasts have become the main reason for the growth. According to the new forecasts, the committee expects 3 rate cuts next year, while earlier it predicted 1 increase this year and 2 reductions in 2024. The news exceeded market expectations, which a couple of weeks ago were guided by more conservative forecasts. Impressed by the changes in the comments, traders of futures are now set for 5 declines next year. Over the past 2 years, the market expected a softer position, and the Fed tried to manage expectations in an attempt to contain bullish activity. However, this time the situation is a bit different. It's better to prepare for a period of high volatility in the new year. Notably, the Dow Jones gained momentum and entered the overbought area. Since the end of 2007, markets have seen such an overbought level just 3 times. Thus, it happened 7 years ago in December 2016, then in October 2017, and in January 2018. In the first 2 cases, the jump was followed by a 2-month-long sideways consolidation, which ended with a considerable increase. However, in the third case, a rise of 2% achieved during 5 trading sessions resulted in a 12% correction. Despite the extreme levels and obvious overbought conditions, investors should now be careful with forecasts for a rapid decline in indices. It's possible to face both a prolonged consolidation and an update of all-time highs. The S&P reached a new peak. The optimism could be explained by the upcoming reversal in monetary policy. Early in the spring, traders expect to see a decline in the key rate, which may lead to a rise in the stock market. The likelihood of a positive scenario is more than 70%. The event should be taken into account in advance. Once the regulator announces his decision, traders will start selling off risky assets. Investors usually say that one should buy on expectations and sell on facts. From a technical point of view, the S&P lags just 2% to hit new highs, but this will become possible only next year. At the moment, we see local peaks. On Wednesday, the Federal Reserve announced its key rate decision. Statistics show that a local extreme is formed a day after the FOMC meeting. The likelihood of successful short positions rapidly increases. Thus, the peak of Thursday and the whole year was recorded at 4,740 points. A similar situation took place on July 27th. Then, a sell signal formed at the level of 4,600. After that, the S&P tumbled, and the market bottom was found only at the end of October at the level of 4,100. Curiously, no one is waiting for such a reversal at present. The rally could be followed by an insignificant correction amid the market overheating. A strong support level is now located at the previous high of 4,600, whereas the level of 4,800 is seen as a target. On Thursday, the Nasdaq 100 also reached its peak. For reference, the indicator was just 0.5% lower than its high recorded more than 2 years ago. Overbought conditions suggest that even an insignificant failure in the market may force traders to lock in profits after a jump in the Nasdaq by more than 17% since the end of October. Meanwhile, shares of leading companies, including those of the Magnificent Seven, are becoming very attractive to investors. Such tech giants as Alphabet, Amazon, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla may bring profits to their shareholders. Some investors who have missed the 3-month rally are thinking about the possibility of further growth in 2024. Since the beginning of the year, shares of Apple, the largest company by market capitalization, have increased by 58%, while shares of Microsoft, the second largest company, have added 55%. However, the impressive figures are not limited to this, given that Tesla doubled its value by rising 134%, and Meta showed an amazing 170% rise. There are a lot of views about a further rise in the shares of companies with a large market capitalization, which have already manifested excellent performance. Although the stocks could be overestimated, the company's technical dominance is undeniable. Their popularity could be explained by the ability to stay ahead of fast-growing technologies such as high-quality software and hardware, cloud computing, and artificial intelligence. And we continue to monitor the stock market situation to keep you abreast of the latest events. Subscribe to our channel and leave comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.